Hello, everybody. Welcome back to 21st Century Renaissance and another open interest newsletter breakdown. I'm your host, Dr. Michael LoPiano. It's wonderful to see you all. Today is our last options expiry in 2024, if you can believe it. And we are finally, perhaps the first time in the last 2.5 years, looking at a weekly close over $30. In fact, this is definitely the best chance we have had at such a close in the last 2.5 years, without a doubt. We're going to be looking at what the odds of that likely look like today. We're going to be readdressing this question of whether we have definitively transitioned into this $30 to $35 macro trading bracket built out and shaped both by our technicals and by our options landscape. And I'm also going to be thinking about what that will mean in our most proximal price action. For example, we did end up seeing that a bit of a retrace yesterday off of that $34 historic price level test, that top resistance line of our macro bull trend over the past now about 7 weeks. We did see that retrace. We did see that movement back to about the middle of the channel. Are we going to see a continuation of that retracement? Do we continue to move closer to the downside? And what does that have in relation to, yes, a max pain strike of $30, which will be, that is officially, as of today, that is the highest max pain strike we have seen all year, even going back to May, June. The highest we got back in May and June with Roaring Kitty's return to X was indeed only $29.50 at its highest. So we are staring in the face here on December 27th, the highest max pain strike we have seen in GameStop in at least a year, likely much longer than that, right? Going back to 2022. So let's hop right into it. Yes. So first off, right, what did we get yesterday? I talked about this, right? Started my video breakdown process a little bit later yesterday as a result of getting some of my new setup coordinated. So, right, we did talk a little bit about this yesterday. What actually occurred here off of this pop, right? What happened? And basically, yeah, we traded down off of this high. We tested the upper range of our macro bull channel, this bullish regression channel that we've been working in, which has been defining and shaping our price action since the end of October. And right, it corresponded, or it flowed together with this $34 historic price level, which served as a support, right? This is historic $120 pre-split. No. This is historic $138, $140, which served as an important price level way back in 2021 as a support. So we tested this, reversed back to the downside yesterday quite dynamically. Options activity, right? We got a huge implied volatility spike right out of the bat. And but then, right, because of this resistance line here in this sort of range-bound sub-channel we were looking at, we bounced right back up, right? $32 we talked about yesterday being a very large call gamma exposure accumulation strike. In fact, we had about 11% of all of our total call gamma across all current expiries concentrated at $32. So despite the dynamism in this reversal here, right, we sort of smacked into this level, and then we see this kind of scrub back and forth here, right? You can really see where all of this very, very heavy dealer gamma exposure hedging is kicking in, where sentiment is changing, right? Obviously off $34, right? We knew that there was a lot of in terms of gamma hedging, a lot more neutrality here, only kind of barely, not a lot of call gamma accumulation above 33 until we get to 35, right? There was some at 33.5, there was some at 34, but not a lot in this area. And so just as quickly as we shot right up through there, likely being pulled up by a lot of that call gamma exposure, at 35, being driven up by bullish options activities. I mentioned yesterday, especially in my pre-market write-up, that this was what market makers would like to see. They would like to see that really, really fast shot up and test of that upper bound so that it can go back down just as quickly. And then they can ride some bearish momentum off of that reversal and angle for a max pain strike that would be right as bearish trades accumulate in the market, as put gamma comes on the board, or I should say as put OI comes on the board, and as in the money call OI comes off the board, that raises our max pain strike, that makes dealer optimal profitability much closer to where our elevated trading range is right now. It also allows them to nudge the price with to the downside, to possibly reposition our price into a trading range, into a gamma hedging, sort of delta hedging environment that's much more conducive to a close that's closer to max pain. So that is what we got early on. But of course, this $32 position obviously instills a lot of confidence in the market, seeing that as a good candidate for a reversal, right? 33, a decent sized position, not crazy large. And we can see 33 intraday then served as a, this intraday reversal position. So 32 lining up with this this resistance trend line, or I should say this would be within our sub channel. This is the resistance line, the top line of that sub channel that's looked a bit more range bound. That basically forms a trend line between all of our sort of big dynamic bullish pops within this trend over about the past 3 weeks. So I'll be able to show us what that looks like a little bit more closely as we go and take a look at our 4-hour chart. But intraday, certainly, right, these 4-hour levels, it's important to track these 4-hour levels on that macro paradigm, on that bigger trading paradigm on a week-to-week basis, because as we can see here, they tend to overlap with very important either historical levels or call gamma accumulation levels, options levels, and they end up functioning as these crucial decision points for many intraday trades, right? They do influence our price action intraday. So, I mean, if you are someone who is looking for, hey, let me try out maybe some quicker flips. Maybe I want to try out some sort of day trading things, whatever it is, right? I'm not encouraging you to go do this, right? This is not trade advice. This is not financial advice. This is not an exhortation to day trade or to flip positions or to do something like that. Not an exhortation to trade or invest in GameStop at all. But if you are someone who is interested in doing that, if that is something you are already doing, finding places where these technical levels and the options data, especially significant levels in the market maker hedging data with respect to those options contracts, if you can find places where they overlap, that can serve as a very high confidence place with which to enter a trade that would bet on some sort of reversal. Again, right, this is not perfect. These types of indicators are not mechanically causal. They do not necessarily cause reversals. I mean, sometimes they do, but it's not something that is built into the structure of the market necessarily. It is something that is built into human psychology, and so there is a relationship between these symbols, between some dimensions of market mechanics, and its interrelationship to human psychology and human decision making. So, right, these kind of flow together in a non-linear causality kind of model that does provide some pretty high probability, right, at times does provide very high confidence points for potentially basing some of these trades or initiating finding entry points. It can be a good tool. With that being said, right, basically the whole day, 32, 33, right, we were in this very tight range. We didn't really test 32 later in the day. We kind of settled in the middle of the range. Weren't really using our kind of daily scalping type indicators, right? We weren't using VWAP very much at all. This was primarily, I would say, this was primarily an options guided day. So yeah, right, 33, 32, 32, 33, 33 double top, and then 33 again, right? So this is test 4 times. This is testing the integrity of that decently sized call gamma accumulation position at $33. So that really told the story yesterday. Very decent amount of options volume, not crazily skewed in favor of bullish bets. A lot of trades at the mid, interestingly. Over 10% of our options volume, I should say, of our options premium was spent at the mid. So not exactly sure sentimentally where those trades are being made. We did end the day with quite a lot of bullish trades. Not crazy huge, but we do see some decent sized premium being spent. This one was interesting, right? We did get a $35 call for next week come in right at the rate, almost a buzzer beater here. 120,000 spent, 950 contracts. For a $35 call for next Friday. So this, right, something like this that's a big bet on something like maybe an intraday. Yeah, especially it came in where it was already at $33. So that's betting on something like some kind of major buying factor, kind of breaking us back into that 33 to 35 area, 34.50 area kind of trading range, because that's going to lose value pretty quickly if we don't break to the upside like today. So yeah, quite a bit of bullishness late. So potentially some people betting on another break to the upside here. This forms a pretty good question, right? Where do we go from here? We did already get something of a retrace. We stayed pretty stable trading within that 32 to 33 range for most of the day, very tightly bound by our call gamma accumulation positions there, by market maker hedging, potentially higher than traders might have thought. So that's a major question for me. Are we moving into, are we just imminently going to go back up and test 30, 34? Do we make a shot at 35 now? Like, what is this, right? What's really happening here? What are we really looking at? Are we really kind of knocking at the door of a technical breakdown or something like that? And so I decided, something I don't always do in my technical analysis section, but I really decided to do this to go back and look once again. Every couple of weeks I'll do this, but go back and look at our price action in 2020 to 2021. So I pointed out a few weeks ago that we were basically this is how I noticed this actually at the beginning of December, right? I was going and looking at the historicals and saying, okay, well, this requel thing, if we're getting this requel of the 2021, this huge upward volatility event, the so-called sneeze in late January, is that, okay, if that's really what Roaring Kitty meant by the requel back in May, was it really the May-June thing and we're kind of over that now? Or did he mean that we were going to do 2020, 2021 again this year at like all of the same dates and with similar price action and stuff? And so I went back and in 2020 into 2021, right, we had a very similar technical paradigm that we were working within. Standard bullish regression channel, and we traded very respectably within that channel. Very clear trend lines, very clear sort of sub-regression channels that then developed or transformed into something a bit more range-bound, and then after sort of consolidating atop some of our moving averages, moved back to the upside. So we had between October, right? This is October, all the way on the left, November in the middle. Then we've got December on the right, and the very beginning of January here. I think we've got the end of September maybe here. No, that's October OPEX right there, all the way on the left. Right, and then we have November OPEX, and December OPEX in 2020. So, right, really what we were doing, or what we repeated, was we'd go up, we would test the upper bound of our regression channel, and then we would go pretty dynamically. We would, over about a 5-6 day period, maybe a little bit longer, kind of fall back into the lower half of that channel, and then negotiate some support either with the 20-day moving average or the 50-day moving average. So we did this 3 times, once at the end of October, and then we traded back up in the anticipation of earnings, tested the top of the channel, traded down. Earnings was used as an excuse to short the stock, so we moved back down, tested actually right all the way to the lower bound of that channel, all the way to the support line of that channel, and then traded back up, came atop the 20-day moving average, went all the way back again, right? This huge bullishness following December OPEX when Ryan Cohen, right, filed his amended 13D and announced that he had increased his share in GameStop by about 30%, took his total stake in the company up to, what is this, up to 12.9 million shares, something? No, it took it to 9,001,000. That was the key number there. And then traded all the way up, right? We traded up, we extended up above our resistance line here, but then, right, we stayed above it. We hung out right around that line for 3 days, and then traded down, right? So we traded down into the very last OPEX, options expiry, I should say, weekly expiry of 2020, which was on December 30th. No, excuse me, December 31st, I think. Yeah, and we didn't come back until the 4th, big bearish day on the 4th of January 2021, kind of consolidated around the midline, consolidated up above the 20-day moving average, and then whoop, we started to move up on the 10th of January when Ryan Cohen announced his intention to join the GameStop board. So why do I keep looking at this? I come back and I look at this because we are in this same paradigmatic structure. Okay, it is analogous. Our current structure is analogous. It's moving at a different rate. So our price action is determined, as I've pointed out many times, by our movement on the 4-hour aggregation chart. But we are in this same type of channel. We do have a similar relationship to some of our moving averages on this channel. And right, we demonstrate similar behavior with respect to the boundary lines of this channel. It's not exactly the same, right? I'm not saying it's exactly the same, but we are fitted within this this archetype. And what tends to happen after tests of this upper bound, I mean, it was a lot steeper, right? Until after Thanksgiving, this was a much steeper channel. Not much. It was a steeper channel. I'll check myself there. But upon tests of this level, right, moving beyond this, showing overbought, heavily overbought on RSI, does regularly result, I should say has regularly resulted in some more sizable retracement. Not always super dynamically, but it does more or less result in that. That does send a pretty heavy intraday sell signal, just as we saw yesterday. So we did not buck that trend yesterday. We did not behave differently in the face of a touch of that resistance line there. But of course, right, what is now happening? We're back around 32.50 heading into trading today. What's really going on here? Are we potentially going to just kind of doodle around here on top of this resistance line? So this is the trend line I talked about before. This sub channel, which has been transforming a bit more dynamically, something that's been a bit more range bound. As you can see, it's formed more or less by a general trend, the maximal extents of our bullish pops over the past couple of weeks. So we have here all the way on the left, this is the pop from Roaring Kitty's post on X on December 5th. This is the height, trading up to 31 of the bullish response after hours to the earnings report in GameStop. And then these two peaks are last week's bullishness prior to the Fed report reaction on Wednesday. So this forms a bit of a trend line, but here right now that we've broken through it pretty reliably, we've started to trade on top of this, at least pre-market. So what's going on? Can we gain some insight maybe from our historic technical behavior with respect to these levels as to where we might go? I would say probably the highest probability direction that we would take would be to continue our retracement. We've just kind of popped out of RSI overbought, to continue this retracement into the end of the week, into this pocket between the resistance line here on this sub channel and to the midline of our bullish macro regression channel. In particular, because let's see, this would be 24-hour moving average, about midday will intersect this midline. So this makes a proximal downside target, number one. It does provide a kind of nice tight bracket potentially to base some intraday trades. It does favor what I would consider to be hypothetically ideal options dealer maximum profitability. So our max pain now, as I've mentioned at the beginning of our video today, has moved up to $30. I will elaborate on that a bit as we take a look at our options data. But right, it's moved up to $30. And we do have a lot, which is right around, actually it's here's $30. So we do have a lot of call OI open at 31 and 32 especially. Getting the price closer to $30, not necessarily $30 on the nose, right? We don't exactly know what the composition of dealers' portfolios are with respect to, say, the open interest. So we don't know if it's more realistically like 31 or something like that. But by and large, dealers tend to be short rather than long calls, especially on GameStop. So, right, their dealers are incentivized here to take interventive measures to move the price down closer to that max pain point. Now, throughout the day, depending on what options are traded, max pain may move up, invisibly up to something like 30, 50, or $31. It's going to be hard to track that because we won't get new options data, of course, until after an actual Friday, right? It can and does dynamically change intraday based on the positions that are opened and closed. But we won't get that data because we won't have an OI update until after market hours today, which, will mean these contracts are expired. So it doesn't exactly matter to that extent. That data won't be published. So it may move up a bit, but I don't see it moving up to $32, let alone $33. That being said, we have kind of deflected already pre-market a little bit off of this line because we're trading now something like, what are we here? Something like 32.50. Yeah, 32.35, 32.40 is kind of our spread there. We can take a look at it in a second after we get through these charts. But I would say, based on my intuition about what dealer incentives are, just kind of ballparking this, that's what I would say would be the highest probability move. We don't have to do that if we come out and we're kind of neutral, right? I mean, even if we are kind of neutral, right? We have kind of low options volume. It's kind of a non-exciting day, right? Trading between 32 and 33 could make sense. I'll talk about that in a bit when we get to our gamma hedging data. But technically, strictly judging from a technical perspective, I would say trading in this pocket between these two lines is most likely, kind of coming down and meeting the 24-hour moving average. I would say that's our most likely pocket there, just based on technicals. Of course, like I said in the article, I do go into this in some more detail. We don't have a ton of shortable shares available, but we do have some. It is possible that these can be deployed tactically to kind of circumvent some of these technical levels. They can be deployed in a similar way to Thanksgiving. What's sort of strange to me, and what I'm unsure of necessarily how to account for or measure, is something like settlement, or like FTD settlement with FTDs, sort of shorts that were entered a while ago. What would be involved in closing those positions, or at least covering those positions, maybe if they were uncovered. We had a lot of short volume after Thanksgiving, in excess of 1 million shares per day. And we had something like, heading into the day after Thanksgiving, that would be 11/29. We had something like, 2.5 or 2.25 million shares were available to be shorted. And they were used, right? They were used. Richard Newton was really great about pointing this out. I missed this. I was not looking at the total share counts that particular week. I was, very focused on our options data, and I kind of missed seeing those numbers go up. Richard was really great insofar as he was able to see like, whoa, that's a big jump, right? That suggests, of course, that there are, right, where do those shares come from? Is it that somebody just says, oh yeah, today you can borrow my shares? It's more likely that those shares were made borrowable by an ETF creation order. So where institutions are going out, where market makers are going out, they're going to the authorized participants, I think, with ETFs, and they're asking for ETF shares to be created so that then they can receive the securities that are bound together in those, that are packaged together in those ETF shares, right? And so that they can take those and then immediately make them right. They can use those to say settle obligations fails to deliver, so they don't have to officially fail to deliver a particular stock like GameStop, and then they have a fail to deliver window on the ETF where then they can work with these shares for a period of time without actually having to account for them. So it's possible that those borrowable shares were made available through ETF creation orders. And so there's a question kind of going on in the background, right? We've seen kind of some of this inexplicable price action, certainly not necessarily inexplicable, but uncertain, right? Buying volume coming through uncommon sources. So seeing something like we saw last Friday, right? 3 to 4 million shares of volume getting punched through the lit market as VWAP orders, volume weighted average price orders that then are officially settled in dark pools and get an average buy code. That's not common, right? We don't see that a lot. It's possible that just has to do with something like, triple witching, like we saw, ETF rebalancing, something along those lines. But right, we don't necessarily know for certain. And then we see some continued bullishness into this week. We see Roaring Kitty's tweet, which somehow causally affects the price on a day that the market is closed. I have no idea how that would even work. So that to me puts certainly some serious question marks on, okay, what's really going on behind the scenes here? What's really pushing our price action? And basically what I called out in my description here, in my breakdown in the technical section, is what happened to those legacy shorts, right? We've only got something, legacy, I say, those Thanksgiving shorts, right? We've still only got 900,000 shares available to borrow. We've actually seen about 250,000 to 300,000 of those shares borrowed as of pre-market today. It doesn't look like they've been dropped on the tape yet, but I wouldn't be surprised to see some of those deployed tactically throughout the day. Yeah, we're still only seeing 900,000 shares available to borrow. So what about institutions that entered into short positions around earnings? What about institutions that entered into short positions around the time of Roaring Kitty's post on December 5th? What about all those shorts who entered into short positions at $30, $29, $28, $27, right? We saw shorts enter in to positions at $27 shortly before, I think, right, the Wednesday before, that would have been the 4th of December, shortly before Roaring Kitty's post on X on the 5th. What happened to those short positions? Were those closed? If they were closed, if they were settled, then for some reason the shortable shares have not been returned to the lendable pool. So what exactly is going on there? If those short positions have not been closed, if those shortable shares that were gained via ETF creation orders have not been returned or need to be returned, right? So if they were borrowed around the 29th, then they would have something like, right, 36 days from that, 36 calendar days. So they have a T+1 for the original delivery of the to prevent FTD on GameStop. Then they would have a T+35, which they would have to meet following that. So it's something like, I forget, right? Otherwise category did go into a specific formula, several specific formulae on this. So definitely check out otherwise categories 42's big DD on this. I've linked this elsewhere. We definitely talked about this during last Friday's live stream. He was there too, which was great. So right, they have about 35 days, right? Ballpark it like 35 days that they would then have to go and return some of these shares. So we're getting close to the end of that window. over the next like week or so, right? It's been about 4 weeks. It's been about 30 days. If there are still short shares out there, right? If shorts still have open positions that are now underwater that they opened in order to manipulate the price following Thanksgiving, which was heavily manipulated. I mean, not all of it, right? A lot of this was profit taking. A lot of this was the price moving down just from people exiting options positions likely. But what stimulated that looked to me clearly to be interventive shorting. And the changes in the amount of shortable shares that were available between those days, between Friday, November 29th, and Monday, December 2nd, which I wrote about extensively, right? The lendable shares changed, the shortable shares changed very dynamically across these days. I saw them continue to change into 12.4. I also saw bullish volume to counter those shortable shares rerouted into the dark pools to take the authentic ask pressure, buy pressure out of the lit market. I saw that take place, and I wrote about that extensively on the 5th of December, which coincidentally was the day that Roaring Kitty dropped his tweet, dropped his post after about 6 weeks of hiatus. And that was coincidentally also the day that I was permanently and inexplicably and indefinitely, I should say, suspended from Reddit. So all my content wiped, and I was completely locked out of my account. So, right, something like this is going on in the background. Exactly what it looks like, it's very difficult to say. I won't speculate about it too much more, but suffice to say, this stuff is going on in the background. So even though I talk about technicals, even though I talk about options, even though I talk about what is most likely, there are these factors happening in the background that are very difficult to trace that can, of course, disrupt this system. So no matter who you are, right, the reason why I'm not necessarily saying, hey, go trade this, hey, go bet on this, aside from that probably being illegal, not sure, is, I can't account for these factors. I can guess, I can speculate, I can try to build them into my own kind of head probability models, but very difficult to predict exactly what's going on with that stuff. So, but this is a reminder, if you are going out there and trading that stuff, it's always important to remember the risk of those, fourth dimensional, fifth dimensional factors when you're making your probability guesses, right? When you're assessing your risk about making a trade or an investment, that you're also taking that into account. So, however, right, on our longer time frame elements here, something that Bad Robot I know also talked about today, which caught my eye, right, is we are looking at this very interesting RSI overbought touch on the weekly chart. So this is Roaring Kitties, or Rory Kittinger on is it StockTwits, I think is the site where his charts are on. Something like that. It's either that or like Trading View. It's Stock Charts, not StockTwits. StockCharts.com. Rory Kittinger, right? Yeah, points this out. We are getting to overbought on our weekly chart. So normally RSI overbought signals are signs of reversal, of imminent reversal, a bigger imminent reversal. What's curious, let's say, about GameStop is that that's not necessarily the case, right? That we see something like in 2020, we saw that this late year price action was this kind of scrub-a-dub-dub up on the weekly chart in RSI overbought territory that did not significantly correct until the price, went parabolic here during the sneeze in January. We didn't reclaim that area until this sneeze 2.0 here in May and June, and we are starting to drift into that area now. So what Roaring Kitty often would mention in 2020 and early 2021 was that he considered RSI overbought on the weekly chart to be a bullish indicator, which is not common wisdom when you are purely looking at charts, seeing an RSI overbought signal on that level is typically not, you would not come to a bullish conclusion from that. You would not say, oh, this has room to run. But for some reason with GameStop, he considers touching RSI overbought on the weekly timeframes to be a bullish indicator, which to me suggests that he's saying, oh, if this is happening, it's a sign that whatever underlying factors are driving this bullish momentum in GameStop, that they are actually playing out, right? That maybe the price is moving into an area where it's going to be less controlled, or that, if there's this deep legacy FTD or short covering or swaps or something like that, that the closing of those positions is perhaps playing out, something like that. Like I said, I don't want to speculate too much, but it is worth pointing that out. Right, we continue to trade above, it's hard to see here, but right, we continue to trade above the 200-week moving average. We are about to log, what would it be, our 5th consecutive week, I think, trading above that level. So yeah, something like 1, 2. Yeah, we're about to log our 5th consecutive trading week, trading above that level, which is hugely bullish. In 2020 to 2021, we had 7 consecutive weeks trading above the 200-week moving average. Before then, GameStop went parabolic. So something to consider. So what about our options data, right? What are we looking at here in terms of options structure that would suggest something maybe useful about trying to forecast what our price action might be today? So we did get this pattern of an insertion of more out of the money call OI above toward the top of our range, which is something you want to see, mixed at the bid and at the ask. We have a lot of in the money call OI that came off the board. And we had some out of the money put OI come on the board in the lower end of our options sort of macro trading bracket here between 30 and 35. So the effect of that has been a moving up of our max pain level to $30. As I mentioned in the introduction, that's the highest max pain we've seen in 2.5 years. The highest max pain we saw was right in this period was during the May to June upward volatility event. We saw a max pain strike that topped out at $29.50. And of course, we saw no weekly closes above $30, even in that crazy bullish period. So this is the highest max pain strike we have seen in 2.5 years. That is a very clearly bullish sign. I would say as a result of this, there has been no stronger chance in the past 2.5 years for a close over $30 than there is right now, as a result of this being the outlook in the options market. We have come back down to earth a little bit in terms of our put to call GEX ratio. Again, as I pointed out yesterday, that when you see these kind of hyper bullish readings, these hyper bullish ratios where the put to call gamma exposure is going beyond a 1-to-5 ratio, I haven't seen that come together, trend together for more than 2 days. At least in the past year, that's certainly been the case. So I was expecting more or less the ratio to come back down. It's still bullish at a 1-to-5 ratio. I don't want to suggest that that's a bad sign, but this sort of return to earth, the seeing some more put GEX come back on the board, this made sense to me. And as we take a look here at our GEX layout, right? I mean, this is pretty much all you need to see in order to know that we have definitively moved into and transitioned into a $30 to $35 bracket, right? We have neutral gamma all the way down, neutral gamma exposure all the way down below us, very low OI, down below us. We have some light OI above us. Right, we do actually see some calls being inserted at 36 and 37, which is very curious to see how that develops. But basically, yep, trading within this very stable call gamma exposure, dominant hedging environment. What I mentioned in the article, I go into this in a bit more depth, but basically, right, we still have this super high density area of call gamma here between 32 and 33. And yeah, we see ourselves basically trading within that bracket. Today, still, yeah, our price action kind of off the open has been a bit bouncy in that regard. But it looks like, right, that's our, all things, right, I would say ceteris paribus, right, without things, all things being equal, without any interventiveness, without any kind of informational externalities or buying externalities like FTD settlements, needing to close these positions, nothing like a roaring kitty expose, something like that. Nothing like interventive shorting from institutions. That our most likely trading range is going to be here within 32, 33 because of this sort of this clamp, right? This clamp of accumulated call gamma, right? It serves as a very strong volatility suppressant to the downside and a very strong volatility suppressant to the upside. Now, if we sort of get a lower day, a non-eventful day, that's probably what we're looking at. Maybe something like then a close around 32 or slightly below 32 so that this big 32 call position is worthless and dealers can pocket that change. Now, I did notice, and I did point this out in the article. Oops, one second. That, right, so pre-market, we did see quite a lot of shares kind of get borrowed and then not dumped on the tape anywhere in these few hours pre-market. Actually, if I go take a look at these figures here, have these been updated at all? No. So they're still out there. They haven't been deployed yet. Still around 200 to 250,000 that are, somebody's holding on to them, right? That suggests to me that somebody is preparing to potentially use those to tactically short something during the day today. I'm not sure. What I might expect is a purpose for those would be maybe on a test of $32, a downward test of $32. An institution could come in and drop those 200 to 250,000 shares all at once, kind of, sprinkle those on the tape in small orders, but in quick succession, so that then the price really gets coerced or nudged through that gamma level, that gamma exposure level deep enough so that we move into this slightly more volatile area. It's not unstable, but it's definitely more neutral, not as tight, requires less capital investment to push the price around, and it's definitely well below these very large call gamma accumulation positions at 32 and 33. What that would do is it would then change the charm character of, say, 32. It would go from a positive charm to a negative charm, meaning that while the price remains above 32 with a positive charm, the delta value on the 32s is actually going to appreciate. It's going to appreciate, which means then that over time, dealers have to go out and buy shares over time to remain delta neutral with respect to those $32 contracts. When charm is negative, that means negative delta change over time, delta decay over time. While the price is below $32, 32 is in a negative delta or a negative charm regime, which means that over time dealers can sell shares as delta depreciates. Okay, and then $32 serves from a gamma perspective as a kind of lid. It then becomes an upside resistance. So I would expect that there may be a market maker, hey, maybe it's Wolverine Trading itself, that may have borrowed those 200 to 250,000 shares and intends to drop those right on the tape tactically in order to subvert that $32 gamma hedging level so that they can position the price within a much more favorable charm hedging regime and gamma hedging regime so that they can be assured of a finish below $32, maybe even drive the 31s out of the money, something like that. But with that being said, I think the odds that we close below $30 are very, very low. I don't think we are looking at a $30 close today based on really how much accumulation, call accumulation we have here. the strength of support at 30, the fact that we don't have really any open interest in our older range heading into this week's expiry. I think that's what we're looking at. Dealers hypothetically have their maximum profitability point at 30. So it doesn't really make sense to open up yourself to risk to manipulate the price below 30, because you don't gain anything out of that, right? Their gains are kind of maxed out with a close between 31 and 30, something like that. Hypothetically, in an ideal situation, that's based on the assumption that most of their OI is going to be short as a part of their strategy, right? So, yeah, so that's, I think, what we're looking at today. IV, right, does provide us some insight that what we're looking at is controlled. It's comfortably within their risk models. If we were really seriously moving outside the bounds of controlled trading, if we were circumventing, if we were at risk of destroying our technical paradigm, if we were at risk of potentially overextending in an uncontrolled way out of our current trading range, then my expectation would be that dealers, brokers would way jack up IV in order to incentivize option sales and push the price through the corresponding hedging mechanisms back down into that controlled range. Something like what we were potentially seeing earlier in the lead up to earnings, where we saw much higher IV values. Like I said, I'm not seeing that right now. I'm not seeing that yet, but that doesn't mean that our outlook moving forward isn't for some continued bullishness, continued strength in the bull trend. It just might mean that in the short term we have a little bit of retracing back to the downside a bit. A close in the low 30s probably as close to that $30 max pain strike as dealers can afford. And I wouldn't put it past them to try to invest some risk, to try to coerce, to nudge the price below that $32 call gamma accumulation level in order to put themselves in a much more favorable hedging bracket with respect to their maximum profitability as a part of their dealer strategies. So that's that's what we're looking at. You know, the recall is still on. I would say here, definitely, definitely something exciting to keep our eyes on. That's what I have for today. Definitely excited to see where things go. I'm always ready to be surprised. In this case, right, we'll see each other for the last few trading days of 2024 coming up. If you are new to the channel, if you're new to videos, you can always find today's full article linked in the description. If you're watching this on YouTube, if you're watching this on Twitter, it's up at the top of the page. I do these write-ups, I do these analytics of the options market and technicals on GameStop every trading day. The next article will be coming out pre-market. Try to get them out at least 45 minutes before trading, so that you can use that. Potentially, people can use that as a resource heading into the trading day, heading into the trading day, heading into market open hours. On Fridays, typically we do live streams here at 21st Century Renaissance to reflect on the week, to go into some deeper dives into these topics. In honor of the holidays, right? I have some family visiting me, so I'm not going to have a live stream today, but we will resume with our live streams next Friday, and hopefully have some interesting things. Certainly, we always have some interesting things to talk about with our first options expiry of the new year. So see you guys on Monday for another open interest newsletter breakdown, and see you guys, of course, next Friday for our first live stream of the new year. Thanks very much to everyone for watching and listening. We'll see you then. Take care.